and welcome to this edition of Closing Trades, tracking the last 1 hour of trading this afternoon with me, Aisha Faridi, Srishti Sharma as well, joining in from the ET Now Motilal Oswal studios. And no respite for the equity markets. We've even reached the 22,600 prim. So not just that 22,800 got taken away on Friday. We're substantially below that mark. It's a 240-point slide, and I don't think one can really sugarcoat that. The key pressure point today has been metals and technology. And to think of it, metals was actually the safe haven and the only island of safety on Friday, but not quite so. So if you look at Wipro, that's down 3.5%. HCL Technologies getting clobbered by 3.5%. Infosys down 3%. TCS down. Tata Steel, JSW Steel, Hindalco, all these stocks are currently down and out as we speak right now. And it's no different for the broader end of the market as well. You know, that outperformance that we'd been talking about within the SMIDs, that's also now giving up. 176 points, stock standing to the decline, I beg your pardon, with just 56 standing to the advances as we speak right now. Other than that, look at heavies like a Bharti, that's down 2%. It's breached that 1600 mark. And once we get our chartists, we'll get a better sense of what this really means in technical analogy. Just defending that level right now as we speak. L&T is down 1.5%. The Shriram Finance down 1.6%. And at one point in time, heavies like ICICI Bank, perhaps one of the most steadiest of the ships or stocks in this market correction, that was also down 2%. Right now, too lower by about 1.25% as we speak. 12.18 is where that stock is right now. So what's holding out? You are seeing some dots of green within the auto pack for sure. Eicher, Maruti, M&M, Hero MotoCorp. These are some of the names which are seeing some dots of green, and some of the staples like Tata Consumer, ITC, Nestle, etc., along with DRL and Cipla are also where you are seeing some amount of green at least. But Shrishti, what about the newsmakers today?
Well, certainly, but not much of the news coming in. There's a clarification coming in from Manappuram Finance. What we are seeing is the company is saying that the discussion with the other players is a normal course of business and nothing much to read about or make any disclosure right now. The stock is still holding on to the gains of almost 2% right now. There's Glenmark Pharma that after that clearance on a litigation from in the US court, the stock is shooting up and holding on to the gains of almost 2.5% in trade right now. But other than that, it's some of these players within the paint sector as well that are holding on to that shade of green, because Berger Paint was one other stock that Kunal just highlighted today morning. That is up around 2.5%. And yes, of course, we have seen that weakness in the crude oil prices as well. So maybe that is also helping us the stock go higher and breaching that 500 mark for itself. Not much of the newsmakers in trade right now, Aisha, but definitely there was indeed a very positive note throughout the day coming in from Citi, where they are saying that they have upgraded the Indian markets and overall by December, and they are expecting 26,000 is the target that they have set for Nifty 50. So we'll try to get more details throughout the show as well, but definitely today has been a day of a weakness, but can't say the same for Nifty Bank because there has been a mild recovery, Aisha, from the day's lowest point at least.
Yes, a mild recovery thanks to names like perhaps Axis and Kotak, which are a little bit of a picking up, but I can't say the same about an ICICI Bank, for instance. That was down 2%, like I mentioned earlier today, and Indocin as well, which reels under pressure consistently. But we've got Kunal and Naresh joining in to talk about what they're making of the trading day so far. We'll get our other experts as well to join in to talk about the fundamentals. Kunal, first things first, what does this breach of 22,600 now entail for us? Because clearly that break of 22,800 has opened up further downside.
Yeah, it opens up further downside for the index, Aisha. But today's selling is not reminiscent of the selling the last 2 weeks. 2-3 weeks. The intensity of price correction in the mid caps and small caps is not there. So I think if you remove the Nifty IT index and the performance which you've seen for the IT stocks today, which I think is causing a large chunk to the damage to the index, we've just been through a normal day of price correction for the indices, where you've seen mid caps after opening with a mild bit of a gap down cut. These stocks have started to show signs of recovery. Banking stocks are the ones where there is some merit, where there is some bit of buying which is shaping up. So I believe that largely we are looking at a point where now we could be looking at a sectoral churn which could be taking place, where the IT index, which was shielding up pretty well for itself, that index could start to underperform. The concern again for the IT index is that the index has now managed to break below its 200-day moving average for the first time in the last 3 odd months. So I think that could be a concern, because now we are looking at a point where many of the large cap, mid cap IT stocks could continue to drag. So this could keep the Nifty under check, but I'm not sure whether the mid caps and the small caps today are falling as sharply as I think what we've seen over the last few days and weeks. So maybe I think major part of the panic, at least in terms of mid caps and small caps, seems to be out, and you could be in for some bit of stock specific as well as sector specific churn.
All right, so stock specific and sector specific churn could be at play, but definitely for Nifty Bank, at least we are seeing a tick by tick recovery. So let's see how that index pans out. But with this, let's also welcome Deepak Shenoy on the show right now. Hi Deepak, good to be speaking with you. So the sector churning is indeed at play, but there's a lot of news flow that is impacting the sectors overall, and definitely the defensives now, the ones considered to be defensives from the likes of Pharma, FMCG, those are also seen to be a bit under pressure. But how do you read into the markets right now, and any sector, given the correction, you wish to flag off where the sector churning could likely play?
Oh, well, I think to be fair, everything is falling. It doesn't matter now whether you have positive earnings or news of any sort. I think across the board, there are no real defensive in a market like this. You'll just fall a little bit less, but you'll fall regardless. And then what I have seen in general is that a large amount of domestic purchasing or buying is continuing, even though we've seen the markets down quite considerably in both January and February. And even now you're seeing daily net inflows into mutual funds, even small cap mutual funds. So to that extent, I think domestic flows have supported things so far. So to a certain extent, while the large caps have not corrected meaningfully, I think at some point there will be that correction as well in those larger caps. And then we should, once the uncertainty around the Trump tariffs and the daily news flow being, out of whack in terms of what comes out of left field, I think when that changes is when you're going to start getting a movement backwards. So till then, I think it's premature to try and say what will improve first and what will not. So we'll have to just live through this news flow as it comes, and just be sure that you're buying into companies that have relatively stronger fundamentals to deal with potential changes in the underlying market, the trading scenario and the trade and tariffs and so on.
Deepak, I think the bigger question everyone's trying to answer now is that, while yes, when it comes to your momentum portfolio, the time to sell is long gone. And I think, one is handling whatever one can handle. But it's more about the question of one's core portfolio, where you're in the money, but you want to know whether you need to protect capital and even sell out of those names, or at least partially take the profits off.
That's, it's an interesting question, Aisha. I was asked over the weekend also about whether you should do this. I think here's the thing. If you are an active investment professional, then you will obviously be wanting to churn some of your stocks because they might have gotten more expensive. Something else might have gotten cheaper. So you can actually make a risk reward analysis and move things around. If you're a long-term investor for whom this is only something to save for the long term, then such corrections are normal. You just continue your investment process as you are as an investor, because you're investing into funds, you're investing into a diversified stock portfolio that's going to give you the protection that you need anyways. And if you need to make those changes, you can make them as companies get more evident. It doesn't have to be like right now. What I feel right now is a lot of decisions are being made on panic selling or some sort, or panic buying also in certain other cases. They don't need to be. This is a time to look at companies again from the valuation lenses and find what's more attractive, and maybe even rebalance your existing portfolio into them. I don't suggest just going into cash anyways. If you're on a momentum portfolio, for instance, our portfolio went into cash only starting January, and we are now a substantial amount in cash, simply because momentum follows the market, does not lead it. So, that's a strategy to be in cash because the market tells you to be. Personally, I think, it's a good time to start investing, building positions regardless. I think in the long term, you will find some of these stocks do much, much better from here. And it's our job as investors to kind of find those stocks and at least build a diversified portfolio of enough of them that will give you a few big winners in the long term. Uh, but this, this is a very broken record. I could say this anytime, whether markets were going up or low, and it would still be valid. So in that sense, not much of a change from an investment philosophy perspective.
Absolutely. But, Deepak, one is now wondering whether those winners should be at least, protected, and should you be taking chips off from there also or not. But anyway, let's talk about what's happening within the IT pack, and some alarming news coming in now. We understand that in a latest development amid furor over Infosys sacking over 700 employees, sources are telling ET Now that the company has now postponed their assessments of employees indefinitely. Sumita Karir, my colleague, joins in with more details on what she's picking up. Sumita, what exactly are you picking up, and why this delay in the appraisal cycle?
So, Aisha, this is essentially about the postponement of employee assessments, which basically means that this was the third round of assessments that Infosys was taking. We've seen, of course, the kind of layoffs that Infosys has conducted. Of course, 300, slightly over 300 is the number that's been put out. However, employee unions and associations or terminated employees debunk that number. They say that the number is much higher and is close to the tune of 700. Now, let's come back to these assessments that are coming in and what sources tell ET Now. Well, in email that's been sent by Infosys to its employees, Infosys says, and I quote, "We're here to help you prepare better and have decided to provide additional training and support from subject matter experts so you can successfully clear the assessment. Therefore, the third attempt of the generic FA2 assessment, originally scheduled for February 24th, has been rescheduled. We will soon convey revised dates." Now, remember, there's been a lot of pressure from terminated employees and, of course, from the Center Labor Department, Labor and Employment Ministry, and from the State Labor and Employment Ministry on Infosys in the manner in which, especially as far as the manner in which these layoffs were conducted. So this would have been the third part of those assessments that took place, which led to those layoffs. Now this has been postponed, and Infosys is giving these employees more time to study, according to what the email that's been accessed by ET Now states. However, terminated students, they're not really convinced. They say, and this is again accredited to sources, that Infosys reasoning is a cover-up. The company did not give such liberty to the 700 employees it forcefully terminated on Feb 7th, and employees were thrown out in a single day without notice, without severance, or even a place to stay for the night. And Infosys is trying to evade further controversy as far as this matter is concerned. Now, what we also know is that after employees or terminated employees wrote a letter to the Central Union Ministry, Employment and Labour Ministry, we know that the State Labour Employment Minister, he had a meeting with officials from Infosys, and he is not very pleased with the manner in which IT companies are carrying out these layoffs. He stated that there is a lack of trust and accountability.
We'll leave it at that. So that's very important news coming in, that Infosys has actually postponed their employee assessments indefinitely, and this comes just on the heels of over 700 employees that they let go of. Other than that, of course, there are statements coming in from NASSCOM as well, wherein they're saying that they don't have clarity on the impact of Trump tariffs on the Indian IT sector. The tech industry is expected to add 1.26 lakh net new employees, taking total workforce to about 5.8 million in FY25. And they continue to say that the biggest unknown will be the tariffs, and the industry is dependent on US. While having said that, they are expecting the tech sector to grow 5.1% in FY25 to about $282.6 billion. And they're expecting the revenues to cross $300 billion by FY26. But I think, Deepak, in the interim, as NASSCOM themselves are saying, it's going to be quite a bit of sort of dark hole, if you will, when it comes to IT, and I think would be best to steer clear. What's your thought?
Well, I think it's kind of unfortunate that this whole hiring thing is turning. You're not supposed to not be able to fire people for not being able to clear the basics required for a test. I mean, I understand the angst people are going through and this thing, but this is really employment at will, right? If I can't fire people, why would I hire them? I mean, I won't hire hundreds of people if you don't allow me to assess them at some level and fire them. And I feel that's an unfair requirement of employers who've given you, let's say, three different chances to clear a test. People are not so kind in the industry. If you fail like this, there will be consequences much earlier than that. I think we are perhaps, if this is the case, then people will not hire in the next cycle going forward. But yeah, at this point, the threat comes from AI as well. The threat comes from the US trying to onshore as much stuff as possible and therefore reduce offshoring. And so a lot of those elements come into play. We're going to see a lot of the reverse tariffs also sometime in April. So things are going to be uncertain till then. Even American companies are going to be unwilling to make any major investments in growth going forward until they feel the impact of whatever tariffs are going to come, the impact on the US economy, on growth, on consumption, and inflation also, of course. So I think this quarter we'll have to kind of sit out pretty much. If you're invested in IT, you're going to have to wait for the news cycle to be be less uncertain in that context.
Makes sense. That's that on Infi and of course the IT sector, which is really getting clobbered today, as has been the case past many days now. Infi down 3%, TCS 2.5%, HCL, Wipro, all of them down, LTTS, LTIM. Actually, I can't pinpoint a single IT name which is holding out or not selling in excess of 2% today. We'll take a very quick break on that note. Come right back. We'll continue our market discussion with Deepak Shenoy, Kunal Bothra, and we've got Naresh Mirani.
The closing trades on ET now and taking a look at the markets. No substantial recovery from the day's lowest point and still struggling to go above that 22,600 mark. But select auto names as well as select pharma names are doing pretty well in today's trading session. So let's connect with Naresh as well. And Naresh, help us with your reading on the markets, because every day the clear question is that are we hopeful for a recovery? But indeed, there's a bit of a sector churning that is underway. Any sector you wish to flag off at the start that that is looking attractive to you at this point in time and could be in for some bit of a recovery from these levels?
So that could be auto names, because those names have corrected and trying to make a base and relative strength. And on the other hand, there is IT, which is trying to make a fresh breakdown. And a lot of teams in the IT pack are actually making a breakdown move.
Select auto names are doing well, but Naresh, within the auto pack, we have stocks like M&M, Eicher, even TVS for a matter doing well today. So between these names which are at least making it to the top F&O gainers, any particular stock that you wish to flag off?
Continue to look at Mahindra and Mahindra, which has seen a correction and come back. And then maybe on further declines, Hero MotoCorp and Bajaj Auto, they've slowly drifted 30% from the top and could be forming a base going forward.
So base formation could be underway for stocks like Hero MotoCorp as well as Bajaj Auto, which indeed have seen a good correction from those higher levels. But M&M is definitely ruling it from the front, almost over 1% gain right now in this week sort of a market. But moving on to the brokerage stakes on the market then, because from January to February, what has changed? The stance has turned from bearish to bullish. Sharad is here to tell us what some of the brokerages houses are saying right now. Take it away, Sharad.
Well, yes, just as the markets have turned volatile, so have been brokerages' views. To put in perspective, in the month of January, Nomura had a bearish view when it comes to the consumption part in 2025, but a bullish view coming in when it comes to the faster EV adoption. Now, also the D Street bottoming out, if you look at it, the next broking house which would be in focus would be Morgan Stanley. They also stated that the global growth, bunching up of IPOs and near-term risk might be there continuing, but in the month of February, they have turned bullish. Now the cement demand, that momentum is expected to continue. So sector-specific, positive news flows, that's what Morgan Stanley is stating. Also HSBC, they had actually downgraded India to neutral from overweight, and their Sensex target itself, that had come down to 85,990. But now a bullish view is coming in the month of February for HSBC, as they say that US tariff concerns are overdone for Pharma as well. Also looking at Macquarie, they had stated that there is a challenge in the EPS estimates coming in, but overall you could say that there's roughly 18 to 19% of EPS going up. Now also the D Street bottoming out, 4 important broking houses, Jefferies are expecting a short-term bounce, and interestingly they have also stated that overall the conviction, especially in the lower value stocks, is strong. CLSA better than expected Q3 numbers, but notable EPS cuts coming in for Goldman Sachs. Interesting report that stated that the tide is turning for the QSR players. Citi also, they have come out, they have actually upgraded India to overweight from neutral, and the target is set at 26,000. Jefferies also mentioned that the Nifty valuations are at the 1-year forward P, and CLSA did mention that the PBT growth for urban plays has turned positive. So of course, very positive news flows, especially the bullish tone is coming from the broking houses, and that was very different in the month of January where there was a bearish tone.
Yeah, absolutely. Brokerage is already handing out their buy list right now. Deepak, what's yours looking like if you feel the time has come to buy?
You can never time the bottom. So whether this is the bottom or the bottom is 30% more away, no idea. I don't want to predict that. But what I can tell you is that in general, if I were looking at opportunities on the fundamental side, this is a market that has more opportunities available. There is a lot of uncertainty, but uncertainty is a time when you get some good companies at relatively better valuations. Currently, even in the large caps and large cap financials, including banks, we're seeing much better valuation numbers in terms of both historical and, of course, relative to their potential future growth. We're also seeing that certain sectors are sort of bucking the trend a little bit on the downside. So whether it is domestic auto, in some cases domestic financials as well, some of the larger cap telecom names. I think these are closer to their all-time highs than most stocks, which seem to be like 30% off their all-time highs. So I think there is still value over here, but you could expect that the markets are going to be more volatile. So if you're going to deploy, I think, capital, it may be best to deploy it over a certain period of a few months rather than all at once. And because you have the ability to choose, you might, ignore what I have to say about large cap financials and find a manufacturing company that's doing really well as well. So it's, there are more stocks to pick from. So I think, in that context, it is always going to be an interesting time to buy. But again, I say this of every market, there will always be something to buy. And I think, if you ask me, it's just about, going down the rabbit hole and finding the right companies to buy. Today, you just have a bigger universe to look from. And in a market of fear, you will probably be one of the few people buying when everybody else is on a wait and watch mode.
Certainly, but Deepak, we have seen deeper cuts within the broader market space. So from the small and the mid end, any particular theme that is looking attractive to you, or you can help with some of the stock ideas that are still looking attractive to you and you also have it in your portfolio?
Yeah, no, I mean, there are lots of stocks. We've our fundamental portfolio is still, kind of going strong. We've seen some really good results in many of these companies. Now, you might find an expensive name there like a Keynes or a relatively cheaper but relatively lesser known company like a Pennar Industries. But they're all offering value at different levels. One is based on growth, one is based on a change in outlook by management and moving into a higher margin environment going forward. So I think there will always be these choices to make, but we haven't found a single theme that is specific to this market that would benefit. I still think the India theme is that is making for India is actually a theme that will continue. It's been our case for the last 2 years that defense players will do well and continue to do well. Railways players will do well and continue to do well. Domestic manufacturing companies focused on domestic consumption and are available at a lower, a reasonable price, and domestic infrastructure players. I think those themes continue to be of interest to us. but nothing's come to me in this market as saying, okay, this particular theme now is looking more attractive. It's still going to be these broad themes that we're looking at, and specific companies which seem to be able to shine, whether as India continues to financialize, as India continues to promote domestic manufacturing, domestic production itself. I think a lot more opportunities are to be had. So I don't have one theme, but I think the older themes continue to be attractive. The macro actually looks even more attractive today than it did 6 months ago.
All right. Yes, indeed, Deepak. Everybody has been calling it out a bottom, but let's see how much more weight we have to and how much more patience we have to hold for those times to come. But with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us this afternoon. But with this, viewers, let's move on and let's also get some of the ideas from our experts then. And let's get the closing trade ideas from Naresh as well as Kunal. And Kunal, you go first. Tell us which stock are you eyeing at this point in time?
Well, I look at Eicher Motors, a stock which has recovered fourth consecutive day over the last many days of the weakness prior to that. So the stock has made a comeback also above its 200 moving average, as well as a potential swing breakout on the hourly charts. So looks attractive on the short-term play and expecting the stock to continue to move up higher.
All right, that's a buy coming in on Eicher Motors. But Kunal, I must also congratulate you on your call on Berger Paints, because in such a market, if you are giving a buy call and that stock is doing well, then definitely deserves a mention. So kudos for that. But Naresh, tell us your stock idea at this point in time.
So that would be a buy on Mahindra and Mahindra. The stock has corrected from 3250 down to 2650, 2700 levels. Last 6-8 months, that has acted as a support. So expecting somewhat of a bounce back here toward 2750, 2800.
Okay, let's take a very quick break. And when we come back, we'll track the last half an hour of trade this afternoon. Back to closing trades right here in ET Now. Hasn't seen any improvement. In fact, the sectors which were just about barely in the green continue to be so. FMCG, Pharma, and to some degree cap goods and textile as well. Over 200 points lower still for the Nifty, 22,610 for the futures right now, and the spot Nifty will just come up for you on your screens next. Breath as well hasn't seen any improvement. 22,557 is where we're struggling at for the Nifty spot as well. M&M is now the top draw on the index. That's holding up about 1.5%. Trend is seeing some green. 5,068 is where that stock is. Kotak Bank, Eicher, Axis, ITC, Maruti are trying to lift up a little bit, but no improvement whatsoever when it comes to IT, or for that matter metals, and some of the other heavies like a Bharti, which is still languishing around that 1600 price point. There's L&T and ICICI Bank as well, which is under pressure as we speak right now. But Sampath Reddy too joins in on the show with his thoughts on the markets. Sampath, hi, afternoon. Good to have you on the show. I guess, Sampath, everyone wants to know how much more pain, and has the time to start buying at least into large caps come yet or not?
Right. I think, from the peak, large caps have come down about 12-13%, and mid and small cap, more or less about 20% fall has been there. I think, we have somewhat come to the, fairly attractive levels, I would say. Of late, some large caps have also got, taken a hit because of, the reciprocal taxes by the, Trump administration, etc. Some of the sectors like which we used to like quite a bit, for example, pharmaceutical is also quite beaten down quite, sharply. I think most of these sectors have now come to a very attractive, valuations, especially in the large cap segment. Mid and small cap, more so in the mid cap side, maybe some more pain could be left, but I think large cap have come to a very attractive levels.
The take coming in on where the market may be headed right now, and Pharma seems to be one island of safety perhaps. But Naresh, I wanted your thoughts on IT and how much more weakness do you further see? And would there be any IT stocks that you would be willing to short now?
So a bunch of them are breaking down today, so could continue to drift lower. So something like Tech Mahindra, which was holding on above the 1600 mark for the last 6-8 months, has broken down. Even if you look at the larger names like Infosys, finally below the 1800 mark. So they could all drift another 5-7% lower at least.
Okay, that's the take coming in on IT. Could expect some more weakness. But Kunal, let's pick up on some of these large cap banks. ICICI Bank, today itself at the session lows, I think it was down about 2%. It's bounced a little bit from there. And then IndusInd, what do you foresee on the charts for these two?
I think ICICI Bank is a stock which has recently gotten a little bit weak on the charts. The stock, even today, I think right at the start, managed to trade below its longer term average, and this is a break after almost month for ICICI Bank. And then when you try and look at this over the last 4-5 months from the September highs, the stock is showing signs of weakness very recently. So which means that there could be a case where ICICI Bank could start to underperform from a short term bit. But I believe IndusInd Bank could be a different chart altogether. The stock is showing signs of resilience. The major part of the pain seems to be out for IndusInd Bank. The stock is forming a RSI divergence setup. When we look at this in terms of the price reactivity with respect to the market trends, especially on the days when the Bank Nifty is down 1.5%, 1% to 2% range, IndusInd Bank generally tries to outperform, and then the fall is much lesser than the benchmark index, in that case Bank Nifty. So I think that's a sign of potential relative strength building up for IndusInd Bank. I would expect that the stock, once that breaks out of the 1080 mark, I think could start off to be into a much more stronger uptrend. So IndusInd Bank so far looks relatively strong as compared to the other names in the private sector banking stocks.
But other than pharma, where else are you seeing some spots of opportunity? Many are calling banks, and in fact, the entire financial cluster right now are looking ripe in terms of valuations as well. Any opportunities you're spotting here?
In the banking as such, valuations are very, very attractive. We have been liking the large private sector banks. They're trading at a significant discount to what they used to trade at about 3 to 5 years back. And also the asset quality and the growth looks quite good for these banks. Within the overall BFSI space, we've been liking the large private sector banks. There are some stress or pains in the overall in the BFSI space. Maybe for instance, if you look at the microfinance and unsecured lending, there is a pain, and also probably even the capital marketplace, which have had a very good run in the last few years on the back of huge growth in the volumes in the market, in the stock market, have also done very well. Maybe they are also slightly richly valued, but overall in the BFSI space, the lending side of it, we like them. We like the large private banks, much better vis-a-vis any of the other BFSI space.
Interesting. That's the take coming in on banks right now. Just looking at some of the movers today. So yes, there are dots of green within the pharma pack. A Glenmark, for instance, is looking good. There's DRL, which is also holding up in trade. Other than that, you are seeing also some, spots of opportunity when it comes to a VBL, for instance. Look at a Bata, that's holding up 3% right now. United Spirits as well is looking good by about almost 2.7%. And then, of course, there are names like Aloris Labs, etc., also which are holding out. Nestle, Tata Consumer, these are also spaces which are seeing some dots of green, or names rather. Sampath, what about the traditional staples? Has time come to buy them just yet, or would you think that this is just a tactical play right now?
I think the traditional staples are coming to the attractive zone. They're still slightly away from the I would say an attractive PE multiple, somewhat about 35 to 40 is a fairly good multiple for these stable companies which used to enjoy for a long period of time. If you look at current valuations, they may be about 10% away from these levels. So I think staples is one of the place where one could stay invested, at least given in this market, as we believe that overall some sort of a pain left in the market as such. Given that view, I think consumer staples will be a better place to hide, at least for the near term. And also, with another 5-10% correction in these stocks, they will again come to a really attractive zone.
That's the take coming in on the staples then. But amidst this market, what we are seeing is that some of these stocks are definitely holding well, and case in point being Bata. And Kunal, if you can help us with your chart check on this one, because there's actually no significant news flow in this one. But just on Friday, when the markets were trending lower, the stock held up. Even today, a 2% jump. What do you make out of it?
I think the only reason for that is Bata is going out of FNO. This is the last series for the stock on the FNO side. So there's bound to be compulsion of closing of positions, and traders who've been short into the stock, they would not, of course, want to convert this, because then they will have to take delivery of the stock, or have to give delivery in this case for carrying off short positions. So I think in that sense, I think this could be a more of a mandatory closing for the short positions, and I think that's why you're seeing the stock up higher. I think we've seen broadly that Bata is a stock which has been a huge underperformer over the last 1.5 odd year. I remember I think the stock was almost at 2,200 levels somewhere in 2021-22, and from there the stock has been consistently forming a pattern of lower highs and lower lows on the long-term charts. I'm talking of it on the monthly basis. So the stock is into a major downtrend, but on the short-term wise, it's just that because of the adjustment on the technical side, you're seeing the stock recovering and then showing some sort of short covering rally.
All right, so because of these adjustments, maybe Bata is seen to have a good move. But other than that, some of the other securities that could get affected, case in point being Canfin Homes as well as India Mart, Ipca Labs is what I can spot in this particular list. But other than that, what we see is that some of these companies, basically from the food and beverage sector, stock like Varun Beverages, they are holding on to the gains of almost 4%. What do you make out of this one, Kunal?
So Varun Beverages could be an interesting case. The stock has fallen from 620 plus levels very recently towards sub 500 mark. I think in the morning the stock was almost at 470, 475 kind of a level, and it's recovered quite well on an intraday basis also. Looks attractive, and I sense that the major part of the pain seems to be out. In fact, in this last leg of price correction for Varun Beverages, when the stock fell from I think 550 levels to sub 500 mark, the volumes were pretty much on the higher side. And generally when you see such kind of a sharp volume and then the intensity of the price correction drops down, you expect that the stock gets into a gradual recovery, as well as at least a stability gets formed. So base formations generally happen when you see strong volume formations into stock prices. I would believe that that could be a case for Varun Beverages. So maybe not a buy on an immediate basis because of the momentum lacking in the markets, but I believe if it comes back to say 475, 480 kind of a territory, it could be a good contra buy.
That's the take coming in on Varun Beverages, once again rescaling to that 500 mark for itself. But in the last half an hour or so, what we have seen is a good move on stock like Happiest Mind, because if we pull up the intraday chart, it's a 8% jump coming in on Happiest Minds, one of the top gainers in NSE 500. Naresh, if you can help us with your chart check on this one, because on an intraday, it's a 55 rupees move on this one. Is this also supported by a good volumes, and what do you make out of it?
So the stock has been in the downtrend and has seen a similar few ticks in the last few sessions. Not a large volume tick as such. Could be a single trade.
It just could be a single trade, nothing much to read when it comes to Happiest Minds, but a good jump, what I could say, is 8% on an intraday basis. But other than that, Star Cement was actually other counter, which was in focus on the back of a brokerage note, where an Antique is highlighting that going ahead in Q4, the EBITDA per ton could actually jump by 40% given the expansion or the new capacities from the northeastern side, helping in fueling the company's growth. Other than that, the cost efficiency methods can also help the company overall. And in the cement pack, we are seeing positive notes also highlighting that the price stability is finally through and the price increases are sustaining for this particular sector. Sampath, help us with your reading on the cement pack and any particular stock that is looking attractive to you at this point?
I think cement also has been going through the rough phase overall in this financial year. So far, if you see the 9 months results, most companies have shown a significant decline in EBITDA and even PAT level. Substantial decline was there in the cement companies. Even if and largely that is because of realizations have been relatively weak and the cost inflation continues to be there. So overall EBITDA per ton for across the board has been sub 1,000 rupees per ton for most cement companies. And unless the EBITDA per ton goes above 1,200 rupees per ton or so, unless you are visualizing that scenario in the next 3 to 6 months, cement stocks probably will still remain underperformers in my view. And even on a replacement cost basis, most cement companies are trading at a substantial premium to the replacement value. So overall in the downturn, stocks generally go to as low as the replacement cost, a slight premium to the replacement cost. I mean, vis-a-vis, if you see in the current downturn in terms of profitability wise, they're still way above the replacement cost. And with that, I think, because of this, as the relations continues to be weak, capacity expansions continues to be going on a full swing, don't see a, demand supply situation easing for the cement producers in a hurry. Maybe, better times ahead for, cement companies. Maybe we could wait for some more, correction in the cement sector for better results.
Sampath, what about, the erstwhile PSC favorites, if you will, your railway and defense names? That's where the first signs of correction began, mid last year itself. But what do you do about them now, given that most of them have fallen, more than 30-40% apiece?
I think, we still continue to think that, valuations are too rich in the case of, the PSUs, which are predominantly the defense and rail sector exposed companies. For most of these companies, the business comes from broadly a single client or a couple of clients, and just that today we are getting we are seeing a good amount of growth in terms of order inflows for most of these companies. The stock prices have gone really through the roof in terms of valuations wise, and and given the way the budget focus which has been there broadly, the capex side has also been slightly moderate. Keeping those things in view, I think there's a long way ahead for these companies in terms of correction.
But with this, just 5 minutes left for the markets to shut shop, and let's start taking some of the BTST ideas from our experts. Then, and Kunal, you go first. Tell us, which stock are you eyeing?
So I'll go with two sell calls and individual names where the stock has shown signs of weakness. So the first one is a sell on InfoEdge. The stock showing signs of weakness, breaking below the 200 DMA. So look out for targets in the range of 7,000. Stop loss at 7,300. And Prestige is the other stock. That stock has confirmed a break of its previous major swing lows, breaking below the the January or the February lows very recently made. That was around the 1200, 1220 mark. So look out for targets in the range of 1150. Stop loss at 1220.
All right, one buy and one sell from Kunal. But Naresh, what about you?
Buy and a sell from me too. First is a buy on M&M with a stop loss at 2690, target price of 2750. Second is a sell on Tech Mahindra, which is broken down below that 1600 mark. Stop loss at 1630, target price of 1580.
Okay, let's toss it across to Snehi then and get us a flavor of how today's day has been.
Well, absolutely. Let's take a look at how today's trading session has panned out, and we have been range bound ever since that gap down open we saw early in the morning. We saw 1% cut coming in, more than 100 points lower. In fact, we've deepened that cut, a 250 point cut coming in on the Nifty. So that's a 1% cut coming in across the benchmark indices, because you also have Sensex that has ended the day with a cut of 1%. The advanced decline ratio was very steeply in the favor of the declines today, but luckily, nonetheless, the India VIX has done pretty well today, because at one point we were higher by 7% on open, but now that has reduced, and in fact now we are on the red. So this shade of red is the only space that's the red is looking good over here. A 0.2% cut coming in on India VIX. 14.5 is where we are. Let's pull up the broader markets and take a look at what the mid cap and the small cap index have done in today's trading session, because we've seen quite the recovery coming in, but nonetheless they've ended the day with a cut of 1%. So that's a cut of 1% on the mid cap as well as the small cap index. So that's not looking very good for the broader markets. Really, the small cap index has in fact intensified the sell-off on that front. Let's take a look at some Nifty 50 gainers and losers in today's trading session. M&M, Dr. Reddy's, Aisha, Hero Moto, all trading anywhere between with gains of 1 and 1.5%. So these are the stocks that held up the market quite decently. But on the flip side, what weighed very heavily was your IT names, the likes of Wipro, 3.7% cut, HCL Tech was lower by 3%, TCS, Infosys, ONGC, Bharti Airtel. Top 4 of the Nifty losers today all belong to the IT space, and that's no surprise to say that Nifty IT was the biggest sectoral loser in today's trading session. That index was lower by 2.7%, so IT is something that has not done very well today. On the flip side, you had FMCG and auto that have ended in the green. FMCG, a surprising winner in today's trade. The likes of Varun Beverages were up 4.5%. United Spirits, Colgate, United Breweries, Nestle, all of these stocks have done pretty well for themselves in today's trading session. On the flip side, Nifty Metal is your second biggest sectoral loser in today's trading session. The likes of SAIL, Vedanta, Hindustan Zinc, Tata Steel, Jindal Steel, all of these stocks have ended with deep cuts in the red. So that is largely what the market construct was looking like in today's trading session. A couple of stocks that were worth highlighting. First of all, you had a Jefferies note coming in on M&M. They've maintained a buy rating, target price of 4,075 rupees. On the back of that, M&M is a stock that has done pretty well, a 1.6% uptick coming in on M&M in today's trading session. CLSA also rather upbeat on the Indian auto space, and they believe that Tesla's foray is not going to disrupt much when it comes to Indian autos. So auto has nominally ended in the green very marginally, but nonetheless, that positive that sentiment on the back of the CLSA note was looking good for auto. Nomura also coming out with a good note on the auto space. City on Interglobe Aviation. Interglobe Aviation was another stock to watch out for. That was a high flyer in today's trading session. City has initiated a 90-day positive catalyst watch, so looking very good when it comes to Interglobe Aviation as well. Also, two other stocks to talk about today, or rather four if you talk about the exclusions as well. The inclusion, two new inclusions in the Nifty 50 index are going to be Zomato as well as Jio Financial Services. Let's pull up both of those stocks. Zomato nonetheless has ended with a cut of 3.2% because it's part of the CLSA India strategy. That stock has been downgraded on the back of its Q3 earnings. So Zomato is down by almost 3.5%. Britannia and BPCL are the ones that are going to be replaced by Zomato as well as Jio Financials. But that's how we're going to wrap up today's trading session. Let's pull up Nifty for one last time because we're seeing a cut of 1% coming in. We have not sustained around those. We have rather been around the 22,550 mark, but that market is also looking a little shaky. Let's give the rate some time to settle in. But a 1% cut is what we're going to have to go home with across the benchmark indices.